participants for participating in this 10 days international taxation refresher course. We are on day 2. We have CA Sudin Sabnis sir, who will be enlightening us on the topic corporate perspective, permanent establishment, and allied issues. Yesterday we had the basics of section 5, 6, 9, and 195, which is the core of the individual taxation. And probably I feel that this corporate perspective or the permanent establishment concept and the allied issues is the core for the corporate taxation as far as the international taxation is concerned. So I'll just request our chairman here, Rajesh sir, to give his welcome address. Over to you, Rajesh sir.
Thank you, Pranav. Good evening. Good evening to Sudin sir and all the participants. Warm welcome on behalf of Pune branch of WARC of ICI. Thank you for joining this series. I believe this series will help many members to clear their issues with respect to the international taxation. I really thank all the faculties who are devoted their valuable time and enlightening us on the subject. I also like to thank Pranav for structuring this series. I also like to thank Ameya and other who supported us to structure this series. I hope this type of series, Pune branch, first time we are hosting this, such a wide level coverage in one series. That also for international taxation. Thank you, Pranav. Thank you, Sudin sir, for accepting our invitation. Thanks to all the participants for joining this series. Over to you, Pranav.
Thank you so much, sir. Before we move on to the technical session, I just would like to briefly introduce our today's faculty, CA Sudin Sabnis sir. He's a bachelor. He's a commerce bachelor from University of Pune. He's a chartered accountant. Also, he holds a diploma in international taxation law. He is Vienna University of Economics and Business. He holds the degree of LLM in international tax law. Areas of specialization are international taxation and the direct tax. He is a partner in international and direct tax practice of Namgia Anderson LLP, which is based out of Pune in India. He's a chartered accountant LLM in international tax law. He has been associated with consulting firms such as Deloitte, PricewaterhouseCoopers, and multinational corporations Siemens over 17 years. He has a rich experience of handling international taxation and transfer pricing matters of inbound and outbound multinational clients across a range of industries such as automotive, information technology, ITES, BPO, shipping, and so on. He has experience of working in India as well as in Germany. He has been involved in various international tax assignments, including advisory and compliance matters. He has a vast experience in advising the tax efficient and end-to-end business models for large turnkey construction and infrastructure projects, also the long-term maintenance contracts, energy infrastructures, and so on. He has contributed articles to various international and domestic magazines and newspapers and has co-authored books in international tax topics. And he has also been delivering lectures and is a speaker at various forums and seminars. Thank you, Sudin sir, for accepting our invitation and enlightening us on this very complex topic, I should say, as far as the international taxation is concerned. So the stage is yours. Over to you, sir.
Thank you, Rajesh, and thank you, Pranav. Pleasure to be here. Thanks for this opportunity. So, of course, the topic for today is permanent establishment and allied issues from a corporate perspective, right? The slides are visible, right? So that's not an issue, I hope.
Yes, sir.
Perfect. Okay. So,
is there any voice issue, Pranav? Someone has just quoted here, not able to hear.
No, actually, I can hear it clearly. Could be the internet issue, probably.
I can hear it.
I'm able to hear it clearly.
Okay, okay.
Perfect. So firstly, good evening, everyone. When it comes to permanent establishments, one of the topics pretty close to my heart. So what I'll be covering today is what is displayed on the slide. Okay. So when it comes to the concept of a business connection, so that's something what is there under the provisions of the Act itself. As I understand from Pranav as well, that this is something what was touched upon yesterday. So I wouldn't really go very much in depth. But I'll just take an overview because that is something which is somewhat parallel, if I can say so, to the concept of a permanent establishment, which is generally found in a tax treaty. Post which I plan to take the various types of permanent establishments, be it a fixed place PE, be it service PE, construction PE. There are some exclusions to this PE as well, which is there under a tax treaty. There is a concept known as an agency PE, and this is and somewhat recent phenomenon is that of a digital PE, right? So this is something which has or will perhaps also slowly make it to the tax treaties, as well as some multilateral instruments in the times to come. Now see what you see on the slide right now is something which is a brief background on this concept of a PE itself. So see, I mean, over a period of time, this PE concept, or rather the business models have really evolved. They have developed. When this concept of PE was really brought in first, so that was perhaps a century ago, right? So somewhere in the 1920s or 1930s is when this concept was really first thought about. And of course, in that era, or for a long time thereafter as well, I mean, you did have businesses which were carried on a cross-border basis, which was typically in a brick and mortar model. In the sense that, for example, if there was, say, someone in the US who wanted to kind of do some business in India, generally it did so happen that, I mean, of course, there was no real kind of great deal of technology advancements at that point of time. So what was per se foreseen is that you have some kind of presence in India, you have some kind of an office, you do have some kind of a person who will represent you, for instance, right? And that's something which was a common model, what was used for a long time. Now, as I said, eventually a lot of business models got developed. There were technology advancements as well, wherein all these kind of concepts, wherein the requirement itself to really have some kind of an establishment, some kind of a presence in the other country, slowly got eliminated. So what you see on the screen, for instance, is an example of Amazon. Okay, so take this to be Amazon US, for instance. Okay, so if you want to.
Sir, sorry to interrupt, but can we have the presentation on full screen mode, because some of the participants are not able to visualize. So probably we can hide the presenter view and have a full screen.
Okay. Let me try my luck. What exactly is going on?
So there was an option when you sharing your PPT. There was two options: full screen and audio.
Okay, let me just check.
Yes, sir.
So if I'm just doing this,
पूर्ण बाहेर जा सर, आणि जेव्हा शेअर पीपीटी ला कराल ना, तेव्हा त्या शेअर करताना त्याच्या अलीकडे ना एकदम बॉटमला दोन ऑप्शन असतात, त्यातला एक ऑप्शन, दोन्ही ऑप्शन सिलेक्ट करा सर.
Okay, so I'll just stop sharing, and when it comes to this, advanced sharing options.
Yes.
Yeah.
शेअर साऊंड आणि ऑप्टिझम फॉर व्हिडिओ क्लिप असं एक ऑप्शन असतो बघा. शेअरचा टॅब असतो ना, त्याच्या लाईनीत एकदम लेफ्ट हँड साईडला.
ओके, कारण माझ्या इथे ऍक्च्युली असं काही दिसत नाहीये. नाही, अनफॉर्च्युनेटली माझ्या इथे असं दिसत तर काही नाहीये.
शेअर ऍडव्हान्स
click on the share screen. You just click on the share screen.
Okay.
One new window will come.
Correct.
So there two options are at the bottom: share sound and optimize for video clip.
Okay, I have to click on optimize for video.
in the yes, in the
Yeah.
advanced tab.
Okay. Yes. Is it better now?
Again, that next slide option is coming now. We don't want this next slide option. That's why the font size become low.
Okay.
So
This next slide
probably we can hide this presenters view.
option, next slide.
Or what I can do is that I can just email that to you if that's
No, you continue. Otherwise, you continue.
okay. Okay. It's somewhat funny, I'm talking of technology advancements, and and that's something which is becoming somewhat of a hindrance. But I'll just try my luck one more time, and otherwise I just continue. Just. So see, I've just clicked on this optimize for video clip. Okay, is there something what I have to do in advanced or in files?
ऍडव्हान्स बेसिक मध्येच येत असं ते. हा, कुठेही क्लिक केलं तरी ते खाली दोन्ही ऑप्शन
खाली दोन्ही ऑप्शन्स आहेत त्याच्यात.
येस सर.
No, I guess that's the same thing which is coming up.
I think we'll continue, I feel.
You're just seeing the notes itself. Okay. So my apologies, but I am unable to figure this out. How basically we can do this. Okay, is it better now?
Yes, sir.
Yes, sir.
Perfect. Sounds great. So, okay. So as I was saying, imagine that this is Amazon US. Okay, and say for example, you are say ordering say an iPhone from Amazon US. All what you do nowadays is that you just visit the website. On a click of a button, you are able to order something. Neither does, assuming, forget about it that Amazon has an India presence, etc. I'm just taking this for a simple example. So in the sense, all what you do is that you kind of order, say, an iPhone, you get iPhone directly from there. Does Amazon really need to have some kind of a presence only for this particular transaction? Not really, right? So you can just order it, they'll ship it from there directly to your address. You get it at your place. So basically, what is now happening is that there are a lot of advancements when it comes to these business models, and wherein there is a big question mark on whether the traditional concepts of the permanent establishment itself are relevant or not. Right. So that's something what becomes important. And then there was a kind of an exercise, if I can call it so, which is known as BEPS, which is known as a Base Erosion Profit Shifting Project, right? So this was a big project carried out by G20 and the OECD in the recent past, wherein they did identify the new business models. They did identify cases in which you do have such type of business models, which kind of also helped businesses to avoid establishing any permanent establishment in India. And thereby and nonetheless carry on business. So basically, why the need for this? Simple, because the thing is, when it comes to business profits, if you have a permanent establishment, so then to that extent of the profits attributable to the business permanent establishment, to that extent the source country gets the right to tax this amount, right? So in this case, for example, if Amazon had a permanent establishment in India being the source country would have had the right to tax the profits attributable to such a permanent establishment in India, right? So which is now no longer not possible because they are doing everything electronically. Now, there were, so in this study, what I mentioned about when it comes to your BEPS, etc., there were a few cases which were identified in which, say, businesses did abuse the traditional concept of a permanent establishment. You did really have cases in which this was circumvented in some way. So there was a multilateral instrument, so basically it's a multilateral treaty, let me call it in that way, in which there was a specific provision for permanent establishment which was added, and wherein they saw that, okay, look here, these are the cases in which businesses are now using advanced ways of circumventing this concept. Let us add this in the existing treaties as well. Okay, so why I'm just saying this at this point of time is mainly because what I plan to take today is that I'll take up all the concepts of the permanent establishment, and at the relevant places, I'll also emphasize on what is now changing because of this BEPS or the multilateral instruments, as I just discussed some time ago. Now, as I said, when it comes to business connection, right? So this is something what was taken up yesterday. So I'm not really going to go very much in depth into this, but this is something which is a concept which is found under the Indian tax law, the Domestic Income Tax Act. So typically, business connection is, say, in Section 9, you do have typically a nexus-based approach, right? So in the sense wherein, for example, you do have essentially, say, a close or a real connection, okay, between the business, what is carried out in India. In that case, there is a business connection, what is really formed. And in case, say, there is a business connection, then profits what are attributable to such a business connection would then be taxed in India, right? So that's something what the typical concept is under the provisions of the Income Tax Act. Now, again, over a period of time, this definition has also been enlarged to some extent. So one aspect of a permanent establishment is what is there through an agent, right? So, for example, if there is a person in India who is representing, say, a foreign entity, or is acting on behalf of a non-resident, then typically the provisions of the Act said that, okay, if he's going to conclude any contracts, he'll be deemed to be acting on behalf of the non-resident. So the profits what are attributable to, in such cases, to the agency function what he's carrying on in India will be taxed in India. Now the thing is, again, as I said, there was some kind of a circumvention, right? So you did have cases in which there was a person in India who did not really conclude a contract, but did play some kind of a vital role in conclusion. Okay, but because the wording said that, okay, only in case you are concluding a contract will you really form a business connection. The provisions of the Act were also changed, and this is perhaps a consequence of the project, the BEPS project, what I spoke about, wherein the provisions of the Act now also includes the wording plays a principal role in conclusion of contracts in India. In the sense, if any person is playing a principal role in conclusion of contracts in India, even in such cases, even though he is not actually concluding a contract, he would be deemed to form a dependent agent relationship or a business connection with respect to the non-resident, and profits attributable to such a function would then be taxed in India. Now, apart from this, there is an important concept what has come in and which has gone live from 2020 onwards, which is known as a significant economic presence. Now, what is significant economic presence? So this is a test what is carried out now, and this is also forming a part of your business connection itself, which says that, okay, look here, in case there is a non-resident who is say providing you any goods, any services, there is a download of software, etc., and wherein if there is a payment, the threshold being 2 crores, if the threshold is exceeded, then he'll be deemed to have a business connection in India. Or say, for example, in case, say, there is a continuous soliciting of business activities, or say, for example, you do have business models in which you interact with the users, right? And then, for example, you do kind of have some targeted advertisements. You do have, say, for example, some sale of data basis the user experiences, etc. So in such cases, there is also a number which is provided when it comes to the specified number of users, which is 3 lakhs. right? So in case, for example, you are providing any activities in which your business model involves your user interaction, which goes above 3 lakhs in India, then again, to that extent, you will be regarded as forming a significant economic presence in India, and accordingly, the profits will be taxed in India. Now, again, as I said, this is something which is there under the Act. Okay, so this is not what we are talking about as a tax treaty, but this is a concept which is very much parallel to what is there under the tax treaty, and this is something which is somewhat of a change, what has really taken place under the provisions of the Act by itself. Now, as we all know, there is a specific section 90 of the Income Tax Act, which says that so with respect to a taxpayer, the provisions of the Act or the provisions of a tax treaty, whichever are more beneficial, would apply to them. Okay, so as we saw, you do have a concept of a business connection, a pretty wide one. Okay, and the treaty, as we will now see, you do have a concept of a permanent establishment, which is somewhat narrower than the concept of a business connection. So in case you do have you are carrying out any business activities in India as a non-resident, and you are not you're not forming a permanent establishment, you can very well take recourse of the tax treaty to say that, okay, look here, there is no permanent establishment as per the tax treaty, and that's the reason there would be no profits, business profits, which are attributable to me, because the tax treaty in that case is beneficial to me as compared to the Act. Now, when we come to the treaty provisions of a permanent establishment, these are the other specific kind of examples or the specific provisions of a permanent establishment, what you will normally see in a tax treaty. So you do have 5.1, which talks of a fixed place permanent establishment. You do have some examples what are given in 5.2 typically. You do have a specific deeming provision of a construction or a service fee and or a service fee in some cases. Typically, you do have Article 5.4, which deals with specific exclusions to the fixed place fee. You do have Article 5.5 to be a dependent agency fee. 5.6 is generally for insurance business. 5.7 is that of an independent agent, and 5.8 to a subsidiary company. Now, as a comparison, as we saw some time ago, we were talking about something which is known as a business connection, right? So which was typically your Section 5 or your Article 5.1, 5.2, and 5.3, right? So that's something which is somewhat parallel to the concept of a permanent establishment. You did have the concept of an agent, what we discussed as well, which is your Article 5.5 and 5.7 in the tax treaty. So I'll now come to what is the concept of a permanent establishment in a tax treaty. So what I've given over here is an example of Article 5.1 of the tax treaty between India and Germany. Okay, so see, this is the example of a fixed place permanent establishment in which really defines that a fixed place permanent establishment would be something which has a fixed place of business through which the business of an enterprise is wholly or partly carried on. So there are a few tests what you have to satisfy to have a fixed place permanent establishment. Now, does it necessarily mean that you actually need to have an office in India, or you actually need to have some kind of a fixed place in India? Not necessarily. Okay, so I mean, yes, of course, for example, you can have an office in India, which more so supports the fact that, okay, you have some kind of an actual fixed establishment here in India. But nonetheless, there could be other cases in which you don't really have something which is fixed, which is really affixed to the earth, for example. But nonetheless, depending on the business, depending on what the facts and circumstances are, that particular object can be nonetheless regarded to be a fixed place. And I'll come to it as an example in some time. So when it comes to a place of business test, as we see as we see over here, the place of business test is essentially generally speaking, wherein you do have a place, okay, which is there, which is permanent. Okay, so in the sense, again, is there any kind of a threshold whether this permanence has to be 1 month, which has to be 6 months, 1 year? There is no such kind of a threshold what is really prescribed when it comes to a fixed place PE. Generally, it is regarded as 6 months. But again, it really depends on what the facts are. What is your nature of business, for instance? Okay, in some cases, it could be as low as 15 days. In some cases, it could be 6 months. In some cases, it could be higher as well. So it really depends on what the permanence is with respect to your activity. One of the most essential criterion over here is the disposal test. Now, what is disposal? Disposal is when the non-resident has some kind of a control, okay, on this place of business. So there has to be a right to kind of enter that premise. You have to have control over that premises, in which case that place will be regarded to be at your disposal. Now, again, as is written on the right, these are all cumulative conditions. So firstly, you need to have a place. That place needs to be permanent. You need to have control over that place, and you need to carry on your business through this fixed place. In such a case, if all these conditions are satisfied, then typically it will be regarded as a fixed place permanent establishment of the foreign enterprise here in India. See, essentially, you do have a condition or other a case in which a permanent establishment is basically nothing but, for example, a virtual projection of what the foreign company does abroad, what they do in India. Right. So it's, as I said, it's not essential that you actually need to have, say, some kind of an office setup. But yes, you need there can be instances in which, if, for example, you do have an equipment, you do have say some kind of even a laptop, for instance, in some cases, an ATM machine in some cases. Even these are regarded as a place of business through which and again, subject to that being permanent, to be under your control, and subject to the business activity being undertaken through it, will be regarded as a fixed place as well. Now, one of the kind of landmark rulings in this context is that of Formula One. This is a Supreme Court ruling. Now, what we were discussing some time ago when it comes to permanence test, as I said, there is no real definition over here. It really depends on what the facts are. Okay, so in this case, what had happened was, and this is a typical Formula One sports event, right? So in which as many of you perhaps may be aware, you do have this kind of sporting event which is conducted all over the globe. There was perhaps once that this took place in India as well, in New Delhi, for which Formula One, which is a UK entity, had entered into a race promotion contract, okay, with an Indian company which is known as JP Sports. Now, what this contract said that, okay, JP Sports, you are to develop this racetrack. Okay, you are going to you are given the right to host this. You are going to you will be given the right to have this stage to promote the F1 Grand Prix in India. But having said so, what came out from the basis of the agreement, what came out on the basis of the findings of the tax authorities was that even though there was this contract with JP in which they had asked them to have a circuit track ready, they had asked them to really have the right to promote the Grand Prix event in India. Nonetheless, the commercial rights to explore this event were still with Formula One UK. They were the ones who could promote this. They had the media rights. They had the rights when it comes to say even the ticketing rights to the event. They had exclusive rights to the entire circuit for the entire duration of the event as well. So as we saw some time ago, the four essential conditions. One, the place of business. Was there a place of business? Yes, you did have this racetrack, right? So because of this, the nature of business, the business itself was of having a racing competition, right? So obviously the place of business was that of a racing track. Was there kind of a certain degree of permanence? Yes, the certain degree of permanence was there because this racing track is that event itself is for a limited period of around 2 to 3 weeks, for which Formula One had an exclusive right over this entire racing track as well as whatever took place during this entire point of time. Was this place at their disposal? Again, yes, because they had an exclusive control over this racing track. And was the business carried on? Of course, because the racing actually event happened during this time over there itself, right? Now, so basically there was a tick mark on all the 4 essential elements to form a fixed place P in India. And that's the reason the Supreme Court upheld the view that yes, Formula One UK did have a fixed place permanent establishment in India for the purposes of conducting this specific event. Now, again, what is important over here is just please have a look into the time period what we are talking about, because this is essential because as I said some time ago, when it comes to permanence, what is important is not really to see whether, that only if an activity is conducted over a period of 6 months, 8 months, that it will be regarded as permanent. We have to see what the nature of the business. Over here, the business itself is for a period of 2 to 3 weeks. You have to limit that permanence only to the extent of this 2 to 3 weeks. If this is, something what lies there in India and subject to the other conditions being fulfilled, a fixed place P can nonetheless be established in this case as well. Moving on to the next ruling in this case. This is somewhat controversial ruling in the case of MasterCard India, right? So this is a ruling of the Advanced Ruling Authority. And this is, something which is now before the Delhi High Court. The hearings are on. The next hearing is scheduled sometime in July this year. So basically, of course, I'm sure most of us have credit cards, right? Credit cards or your debit cards. And so typically what happens when you're going to swipe your debit cards or your credit cards, typically what happens is that there is an interface. Okay, for example, if your credit card is set of MasterCard, there is an interface which is set up. So in this case, in case of MasterCard, Bank of India is a bank, okay, which is affiliated for this purpose with MasterCard, which acts as the interface. So in the sense, there is a particular laptop, okay, a laptop-like device, let me put it that way, what is of the ownership of MasterCard India, which is kept with Bank of India. What happens over here is, whenever, for example, we are going to swipe our credit cards, the information goes to this particular laptop. Whether we have put in our PIN correctly, whether the card codes are validated correctly, and whether our names and addresses are verified correctly. These 3 processes are taken care of through this laptop. If they are found to be okay, then the entire batch of these transactions are sent overseas. Okay, so then they are sent overseas to MasterCard global kind of clearance management systems, right? So which is again placed overseas, be it in Singapore or in other locations. What happens thereafter is that this clearance management system then calculates what is the amount of settlement and what are the fees involved. Once this is clear, they facilitate this to the card holders issuing bank. Okay, so for example, someone has a card of say Axis Bank, which is issued by MasterCard. In that case, the amount will get debited, or rather this information will get passed on to Axis Bank, and the amount will then stand debited to your account. So this is an entirely automated process. Yes, there is a human intervention, but which is limited, far more limited in this case. But as I said, essential elements over here in this entire transaction are that you do have MasterCard Singapore, which kind of has these kind of application softwares. You do have MasterCard India, which owns these kind of laptop or whatever equipment what is placed at the site of Bank of India. There have been people traveling from Singapore, from MasterCard Singapore to MasterCard India, who have been overviewing or the entire processes, etc., etc. And you do have the entire system to be under control, right, of under control of Mastercard India. So that's something what is coming out in the agreement. Now what happened is that initially Mastercard didn't have a subsidiary in India. They had a liaison office in India, and over a period of time, due to several disputes, etc., they formed a subsidiary. Now, nonetheless, they decided to approach the advanced ruling authority and ask them that, okay, look here, this is the entire activity what I'm doing, whether they would be a permanent establishment of Mastercard Singapore in India as a result of this entire set of activities. Now, what was interesting over here is that the AAR said that yes, there would be a permanent establishment of Mastercard Singapore in India. And there would be a fixed place permanent establishment as well as some other types of permanent establishment. I'll come to that later. Particularly because, and one of the important relevant facts was that the Bank of India, right? So the place where this, for example, this laptop or this equipment is kept was ran on the application software of Mastercard Singapore, which was in the control of Mastercard Singapore. This entire transaction, this was something which was an essential element of this entire transaction. Though of course you did have a lot of other essential elements when it comes to the role of Mastercard India. You did have some towers, etc., some cable lines and all these things. But nonetheless, this is something which was deemed to be the most important portion. That this is where Mastercard Singapore holds control over this equipment. And because it holds control over this equipment is placed on the premises of Bank of India, and it was deemed to be at the disposal of Mastercard India, of Mastercard Singapore in India. Now, because as I said some time ago, when it comes to a fixed place, it is not necessary that you need to have an office. In this case, what was regarded is that this equipment, in this case, something like a laptop, for instance, being at the disposal of a foreign company, was held to be a fixed place permanent establishment of Mastercard Singapore. And that's the reason they held that, okay, look here, you do have a fixed place PE, and accordingly, the profit has to be attributed to this fixed place PE in India. Now, this is somewhat controversial, as I said some time ago, mainly for the reason that the tests which are laid down by the AAR appear to be a little narrower. Okay, in this case, there are the activities what were undertaken by Mastercard rather the equipment in this case typically was that of processing your PIN, your address verification, etc. Whether this is something which is a business activity, which is a core business activity, or say for example, which is a preparatory business activity, etc., was also what was discussed. But nonetheless, this was also deemed to be a core business activity, right? So this is something which was held by the AAR. As I said, this is something what was held to be a permanent establishment, and which is now placed before the Delhi High Court. So let's see. I mean, this will be interesting to. I mean, the hearings are ongoing. In this case, it will be interesting to see what the Delhi High Court finally holds in this as well. Now, moving on from this concept of fixed place permanent establishment, as I said, you do have Article 5.2. Article 5.2 typically is gives you certain examples, okay, of what is a fixed place permanent establishment. It could be an actual, say, branch office. Could be say a simple office, it could be a factory, it could be a workshop, it could be, say, a sales outlet, it could be a place of management. So there are some examples which are generally given in all the treaties what India has entered into, which you will find in Article 5.2 of a tax treaty. Now, is this something which is independent of your Article 5.1, or is this to be seen as say something which is only illustrative to the example of a fixed place permanent establishment, what we just saw, which was there in Article 5.1. So again, there are rulings which including Supreme Court rulings, wherein it has been held that 5.2 typically is illustrative in nature. So basically, it is nothing but which gives examples of what could typically constitute a fixed place P. So these are not really independent type of examples that, irrespective of whether you don't satisfy the four essential conditions of a fixed place permanent establishment, but nonetheless, you do have, say, a warehouse, whether you will still form a P, not necessarily in that case. Now, again, what is an example, perhaps what is pretty much relevant in today's context is that of a home office PE. See, ever since COVID took place, there have the business models did again change. You do have a lot of cases in which people work from home. And I'm not talking of just working from home within India, for example. You do have in a lot of multinationals that people have been, say, relocated. Now they kind of choose to stay at one place itself, or they decided to go back to their respective homes in their respective countries. And you do have cases in which they do allow you to kind of even work from home permanently nowadays. Now, one such example came before the Danish court. Okay, so this is an example, not an Indian example, but this is an example of the Denmark court, in which you did have a CEO of an entity which was based in Norway, okay, who worked from his home in Denmark. So there was a company in Denmark as well as a company in Norway. The CEO chose to kind of work. The CEO of the Norwegian entity chose to work in his home office from Norway itself, from Denmark itself. Now, what took place over here is that what was rather understood is that he spends around 65% of his working hours in Norway, 35% in Denmark. He holds 20% of the shares in the Norwegian company as well. Now, the question arose whether his presence working from home in Denmark would give rise to a PE of the Norwegian company in Denmark. The Danish tax board held yes, that could give rise to a place of to a fixed place permanent establishment, essentially because of his stature of being a CEO of the Norwegian entity. He was one of the key managers who kind of took decisions and was a key person in the who really took most of the decisions, right? So so the place of management was held to be there in Denmark for this Norwegian entity. Now, this is somewhat important because you do have a lot of companies, even in India, for example, who do have, say, offices in the US, who do have offices in Europe, etc. You do have your group CXOs, okay, be it your CEO, your CFO, etc., who may be situated or who choose to be kind of situated out of the US or, say, out of Europe. What happens in such cases? In such cases, would they be exposed to being or resulting into a PE of the Indian entity? That's again now something which needs to be evaluated, and this is something what is now essential, especially in this changing scenario of working from home now. Now, moving on, I'll come to a construction PE, right? So what is a construction PE? So typically, you do have say an EPC contract, right? So for the benefit of all, an EPC contract is nothing but say a turnkey contract, okay, in which you do have typically essentially four important elements. You do have offshore supplies, in the sense, for example, you do have, say, assume that you have a German company, who has one contract for, say, building a metro project here in India. Now, in India, so what happens is that typically an EPC contract would mean that there is a contract for offshore supplies. Offshore supplies in this case would mean that the supplies would come from Germany to India. There would be offshore services, again, services provided from Germany with respect to this metro project in India. You would be having onshore supplies, that is supplies within India, and you would be having onshore services, so that is services within India. Now, what could be these services within India? Typically would be your installation activity, your construction activity, erection activity, etc. Now, with respect to this, generally these contracts are split. Okay, you do have typically two contracts. Okay, so in the sense you do have one contract which only deals with the offshore portion, saying that, okay, look here, this German entity would take care of the offshore supplies and the offshore services from Germany. And you do have another contract, okay, when it comes to the onshore scope of the project. Again, it could be with the German entity, or say, for example, it could be, for example, with a subsidiary of the German company in India. Okay. So, for instance, for example, you do have Pune Metro project, right? So it could be a case that, say, there is a German entity which has the scope for the offshore supplies, and you do have the onshore scope with the subsidiary of the of this German entity with your Pune Metro, right? So that's something which could take place. Now, how is this relevant? Now, when it comes to construction PE, construction PE is something which is a deeming fiction, which is typically found in Article 5.3 or is sometimes in 5.2 of the tax treaties entered into by India. Typically, it reads as I have just given 3 examples over here, and all 3 are different set of examples. Typically, it reads that it is a building site or a construction or installation project, or it could be, say, supervisory activities which last for a prescribed a period of time. So typically there are a number of days what are given in each treaty. It could be 183 days, it could be 120 days, or say for example, there could be multiple projects and they could be combined together. As you can see in the India-Italy tax treaty, it says together with such sites, right? So each treaty has its specific wordings, and of course that makes a lot of sense to kind of read each treaty separately and in that particular context, because there is no kind of straight jacket answer or rather one solution fits all approach in any case under international tax law. So obviously each treaty is unique. As you can see over here, all the 3 examples what I've quoted are somewhat unique. When it comes to India-Italy DTAA, you do have a case in which you do have a construction or an installation project in which you have to calculate a period of 6 months, which is a cumulative thing, that is together with such site projects or activities. And along with that, you do have say a different condition when it comes to supervisory activities in connection to machinery or equipment, etc. You do have an India-Indonesia double tax treaty, which is a plain and simple thing which just says that, okay, in case you are providing such activities for more than 183 days in India, you will form a PE in India. Or say, for example, you do have India-US, which is somewhat of a mixture of both India-Italy as well as India-Indonesia, which says a building site or a construction activities, it talks of together with such sites, and it also says continues for a period of more than 120 days in any 12-month period, right? So this is, I mean, these are perhaps 3 kind of different examples, what are typically found in the tax treaties, what India has when it comes to a construction PE. Now, when it comes to a construction PE, so a few things what are important in this case is, and wherein, say, for example, a lot of litigation thereby lies, is, for example, when does this construction PE really commence? Does it commence, for example, when the goods are supplied from offshore? Does it commence, for example, when someone comes here to kind of fill up the tender form? Does it kind of start, for example, when, for example, you really win the project and you just come here to do some site leveling activities? Or say, for example, you come here nonetheless for some preparatory activities. When does this actually commence? Again, something which could be pretty much factual, but in some cases, again, depending on the facts, it has been held that even when you do come here to have site leveling activities as well, that could also be considered to be a point in which the PE can be said to commence, right? So the onshore duration, what we saw in the last slide, the period of 6 months in India or 183 days in India, the date when this starts is, for example, the date you start your site leveling activities. In some cases, for example, where this is not required, when, for example, the goods are supplied, etc., and then you do actually start your installation activities. It's from the day the first person starts his installation activities in India is when the PE would start in India. Now, again, what is important over here is in the example what I gave you. If, for example, the contract is say between the foreign entity only for the offshore scope, the contract for your onshore scope for installation activity, etc., is with the Indian company, and the Indian company is capable of doing this onshore scope on its own, right? So not really, for example, entirely depending on the foreign company, but is capable of doing this on its own, then of course there will not be any question of a PE, because all the onshore activities will only be done by the Indian company by itself. So when is this PE relevant? The PE is relevant when you do have the foreign company providing these type of services in India, right? So for example, when you do have people coming in from Germany, in my example, providing this installation activities, doing the site leveling work, or providing your commissioning activities, when they start their activity, it's only in such cases that this period will actually commence. Now, when does a P end? So what is the cessation of a P? So it could be a case, say, for example, that you do have your kind of installation activities which, say, get completed. And typically in case of an EPC projects, there are different certifications what are received. So one such important certification is known as a PAC, or a Provisional Acceptance Certificate. This is generally a document which is issued by the company who has awarded this contract, saying that, okay, look here, we accept whatever works you have done, subject to, for example, a few things which are typically your warranty cases. In such case, if you have received the PAC, that is generally regarded as the period till when the activities have now concluded on site. Okay, so the date on which the foreign employee would first land on site as representing the foreign company, and the last date till when he would be there on the site and you actually receive this PAC, this entire period will be regarded or will be counted for the purposes of calculation of this threshold of 6 months or 183 days. Now, it could so happen that you do have employees who kind of frequently visit India for such activities. They'll be going back, etc. There would be interruptions. Okay, there would be permanent interruptions. There would be temporary interruptions. So what happens when it comes to these interruptions? Are these interruptions counted? So yes, irrespective of say, for example, whether once you start your activity, and for example, if the person is going back for some kind of a few days, which is a temporary kind of an interruption, he comes back to site. The intervening period of the duration when he goes back to Germany and comes back, that is also counted in this period of 6 months. So that is not excluded. But when there is a permanent exclusion, rather permanent interruption, in that case itself, and that is in a very rare case in which this is something which is deemed to be excluded. Now, what happens, for example, if, for example, this entire contract is, say, with a foreign entity, and the foreign entity, say, has subcontracted the work to an Indian, say, an Indian entity or another, say, associated foreign entity. Does this threshold work in such case as well, and with respect to whom? So in such cases, typically, what happens is the subcontractor's activity are counted in the main contractor's activity, the main contractor's threshold, the time limit, and that's how the period of 6 months is usually taken into account, right? So that's something which forms an essence of a construction or an installation PE. Now, typically, when it comes to an EPC contract, it is generally followed by an O&M contract, so which is your operation and maintenance project. Now, does it mean that when it comes to an operation and maintenance project that is also included in your construction and construction PE? Not necessarily. As I said, typically it does so happen that you have a construction activity in place, you receive your PAC, and once your site is ready and your time limit ends in that case, as we discussed some time ago, your operation and maintenance work starts thereafter. Okay, so all this kind of operation and maintenance work typically is not really counted in this threshold of a construction PE. In the construction PE, once there is a cessation, that's where it ends. Now over here, there are a couple of cases what I just wish to discuss, what have reached the high courts as well. So this is one case what you see, which is there of the Bombay High Court. In which there was a Mauritian tax company, Mauritian tax resident, who was engaged in transportation and installation of offshore platforms, and there were multiple projects, which were carried on at that point of time. Each of these multiple projects were for a duration of less than 9 months. Now, the definition of a construction PE in India-Mauritius tax treaty does not have the wording together. Okay, so what you have to see in this case is that you have to see each project independently. If only in case the independent projects, the threshold for the independent projects exceed the limit of 9 months, will you really form a PE? Not really otherwise. So in this case, the tax officers had sought to aggregate all the projects and had sought to kind of tax this company. So this is something which was overruled by the tribunal and was upheld by the Bombay High Court, saying that no, you can't really do so. You have to see each project independently. Another interesting case was that of void paper. Now this is something which wherein you did have two contracts. Okay, so you did have two contracts for supply of equipment, and the another contract was for commissioning of the plant. Now, what the taxpayer in this case, which was this German entity, they contended that, okay, look here, the India-Germany tax treaty says that in case that there is a construction activity, and if it goes beyond the period of 6 months, in that case will there be a construction activity in the first place, then you can have something attributed. So they said that, okay, look here, the PE, if at all, is considered only for the purposes of your service activity and not really for the entire project scope. Okay, so regard these as two separate contracts. One is a contract for your offshore scope and one is a contract for your onshore scope. Only with regards to your onshore scope will this be taxed and not otherwise. Now, what was held by the tribunal in this case, and this is something which was also held by a Madras High Court decision, which is in the case of Ansaldo, which is currently again before the Supreme Court, that you actually have to see what is the nature of the contracts. Okay, you can't just plain and simply, just for the purposes of avoiding the PE threshold or avoiding aggregation of your income taxable in India, that you can just kind of artificially split a contract. You have to see what is the essence of the contract. In this case, whether what the dominant purpose of the intention of the buyer, right, was from the very beginning installation of the machinery under the supervision of the assessee. Unless and until there was this machinery, unless and until this is something which was installed, that's of no use to me. So the contract was structured in such a way which was a composite one. You couldn't really read them as two separate contracts. Even though there were two separate contracts, they were very much linked to each other. So this linkage was that unless and so what the buyer wanted was that, okay, look here, I want this machinery installed at my premises. That's what his ask was. Now, unless and until that took place, he was not going to give any kind of certification for the offshore scope or for the onshore scope. So it was very much clear for him that, okay, look here, if this is something what it is, only then it is acceptable to me, not otherwise. So the contracts were essentially linked. If they are inextricably linked in such a way, the High Court, rather the tribunal in this case, observed that, okay, look here, this is something which has to be seen as one contract, as a composite contract, and in such case, basically, you cannot really regard this to be kind of taxed, or rather to be split artificially, and you really have to see this the supply as well as the service contract as one itself, and accordingly have this taxed. Now, this is something, as I said, the principles have traveled way up to the Supreme Court. This is again the hearings are what are ongoing at this point of time. So let's really see what the result is. See, essentially, it's something which really depends on what the nature of the contract is. It really depends on what the facts are. If the facts support your case, then yes, this is something which I mean, the contracts can be kind of structured accordingly. But if the documentation do not really support, that's really a risk what one would absolutely carry. What I've done over here is I've just given a few pointers, especially for your for cases in which you do have construction or in such case of EPC contracts, wherein a foreign company would be required to be somewhat somewhat cautious about. First is whether the contract is a composite contract. So as we saw in the case of Voith, whether this is one contract for offshore as well as onshore, for the services and the activities conducted in India, what is the actual essence of the contract? Or can it actually be said that, okay, these are two different contracts, two different parties, two different scopes? Whether the goods, what are supplied, where is the transfer of risk and rewards of these goods? Are they outside India, which could be the best case scenario? But what if it's only a case that your Incoterms suggest that they are outside India, because Incoterms typically govern the transfer of risk, but not the ownership. And your ownership is something which is nonetheless is there in India. What happens in such cases? Who actually conducts the onshore activities? Okay, so that's regarded rendered by whom, the Indian entity or the foreign entity. Whether say any personnel are deputed to India, in the sense not really seconded, but just sent to India by the foreign entity to help the Indian entity execute the contract. Or say, for example, they come to India to really supervise and control the entire proceedings. What happens in is that what the fact is? Depending on the answers for the first four, we'll be able to arrive at a scenario whether there is actually a PE of the foreign entity in India. Because in case, say, for example, your kind of activities, what you're doing onshore is, say, done either by the foreign entity directly or by the Indian entity, but essentially governed by the employees of the foreign entity who have absolute control over this, there definitely could be a risk for the foreign entity to have a permanent establishment in India. Of course, you need to also see whether then in that case, what would be the attribution? Because again, each treaty has a specifics, and some treaties specifically excludes offshore supplies from the attribution scope or to such a kind of a PE as well, right? So these are a few things, what one needs to absolutely be very clear about. And when it comes to composite contracts, when it comes to offshore supplies, again, what is important in this case is the provision in the contract on passing of the title. As I said, title is extremely important. You need to see what does your contract really say, whether the ownership is kind of passed outside India or is it really passed in India. What are the Incoterms, what are attached, whether the title documents are tendered to the buyer or is agent outside India, for instance, who is the importer on record. So all these important documentations need to be maintained, need to substantiate our claim that whether this is actually an offshore supply, whether say there is any element of an onshore scope, etc., which will really help decide on if at all, firstly, even these elements would be taxed in India or not. Now, so some time ago I spoke about this concept of BEPS, right? So what took place is that when you did have these thresholds under the construction PE clause, and under the construction PE clause, as I said, you did have that in case the foreign entity is going to provide any construction activity in India, say which is exceeding a particular threshold of 6 months or whichever period what is given in the tax treaty. In that case, they will be regarded as, say, having a PE, and then there would be an attribution. What came to the notice of a lot of tax authorities is that there is an artificial splitting up of contracts in a lot of cases. For instance, what used to happen is that in my earlier example, you did have the German entity, okay, who had this contract for Pune Metro. assume that they had the entire contract for Pune Metro. What if, for example, the German entity said that, okay, the P threshold in my case is 6 months. This contract is, say, going to take 30 months. What if I split this contract? Okay, so in the sense, I will kind of have 5 different contracts with Pune Metro. One, say, with myself, with, say, for example, the German entity, with, for example, my associated enterprise in France, in Switzerland, etc., etc. And that's how I'll execute this contract. Assume that this is fine with the person who's tendering this as well. In that case, essentially what happened was that you had to then look into each treaty. For example, if France is going to provide something which is below the threshold, France is out. Germany restricts itself to a period of 6 months. Germany is out. And the relevant other countries could also be out. And essentially, there could be no real construction P in India, even though for that project, you did have an activity which was ongoing for a period of 30 months. Now, to address such a scenario, what took place is that in the BEPS project, there was an amendment what was proposed to the existing clause of a permanent establishment. And what was this amendment? The amendment is where the enterprise's site or project carries on activities for a period of 30 days without crossing the threshold already provided for in the treaty. So, for example, in my example, when it comes to the German entity, say if it is providing services for a period of, say, 45 days, it's not crossing the limit of 6 months, but it is exceeding this period of 30 days. Plus, so cumulative, where connected activities, so connected activities, if they are carried on at different times by one or more such enterprises, closely related enterprise at the same site or project or any other such place identified in the existing relevant provision of the tax treaty for a period exceeding 30 days. So in my example, what took place for the 30 months was that I artificially split it, say, between 5, 6, 10 entities to really restrict this below the threshold for each country. Now, what is proposed is that if, for instance, there is this German entity which is going to provide such services for a period more than 30 days, and if the aggregate duration of my related entities also exceeding a period of 30 days, it will be deemed. So all these periods will then be counted as one, even though your existing tax treaty does not say so. Okay, so basically this is a provision which is there under the multilateral instrument. Now, mind you, this is something wherein India is silent at this point of time on the applicability of this provision, but there are other countries which have already applied such provisions as well. What I have extracted over here is the provision of the Germany-Australia double tax treaty. Now, this is, mind you, also something which was done even before the MLI was implemented. Okay, so what it reads is, where an enterprise of a contracting state, for example, where an enterprise of, say, Germany, carries on any of the activities referred to in para 3 and 4 in the other contracting states, so which essentially relate to your installation or commissioning activities in Australia. Any connected activities carried on in Australia during different periods of time, each exceeding 30 days by one or more enterprises closely related to the first mentioned enterprise, will be added to the period of time during which the first mentioned enterprise, so the German enterprise, has carried on the activities for the purpose of determining whether the periods referred to in para 3 or 4 have been exceeded. So the 6 months threshold, what is there for Germany, Australia, DTAA, will stand crossed if, as an aggregate for the same project, the duration has been split, right? So, for example, say if there are, say, 5 associated enterprises doing different set of activities for the same project, it will be an aggregate. If it exceeds 6 months, the German entity would be regarded as having a P in that country. So this is now a change which is being which is there already in the multilateral instrument. As I said, India at this point of time is silent, but wherever, say, for example, the other tax treaty partner does agree to such a change, this is something what we can also see in the Indian tax treaties in future as well. Now, moving on, you do have another type of a P which is known as a service P. So service P is wherein, for example, apart from the types of services what we saw till now, when it comes to your construction service or your installation service, for instance, if you're providing some kind of other services, say including consultancy services, generally which are excluded from your definition of Article 12, which specifically deals with fees for technical services. So generally, which is something which is not really forming a part of your Article 12. And say there are some services being provided, for example, by an entity in the US to an entity in India. If this kind of services exceed a period which is prescribed in the relevant tax treaty, then it could also give rise to a P, which is known as a service P. Now, again, as I said some time back, these are deeming provisions. You don't require an office. You don't require any kind of such kind of actual fixed place over here. Even if, this is purely based on the nature and the duration. That's it. Okay, you don't really actually are required to have something at your disposal, or when it comes to fixed place, etc., etc. This is a pure deeming provision. So when it comes to your nature of activities, being a service, exceeding period of 6 months or whatever is there in your tax treaty, you will be deemed to have a service fee in India. Now, what you can see in the table below is are some kind of examples what the treaties what India has signed do really say. So peculiar amongst these are the US and the UK tax treaties, which say that, okay, if you are providing some services to a non-related enterprise, and wherein the activities in which you are providing such service, they continue for a period of more than 90 days, within any 12-month period, if it exceeds a period of 90 days, you will form a P. But if you are providing any service to a related enterprise, in such case, even a single day, provision of services even for a single day will result into a P. So this is somewhat harsh, but that's what the wordings really do read. As I'm saying, for a single day in case of US, it is a period of 30 days when it comes to UK, 30 days in any 12 months period. And similarly, you do have a period of 30 days in Singapore, etc. Now, one question what comes to mind is, how do we really read this period of 30 days, or whenever this threshold is there? Okay, when it comes to service P, or even in the context of a construction P, right? It could so happen, for example, in the construction P, it could so happen that there were, say, 4 employees on site on one single day. Will you count this as 4 days, or will you count this as 1 day? Okay, so basically, essentially, are you to calculate man days or solar days? The answer over here is you will calculate this only as 1 day. Okay, so this is not really 4 days. So you can't really say that because there are 4 people on 1 day that there are 4 days. You have to see this as 1 day by itself. Now, again, when it comes to service P, there have been a lot of important rulings, right from the Supreme Court in the case of Morgan Stanley. Right. So essentially, what had taken place in this case was that you did have Morgan Stanley US, which has outsourced some of its activities to its Indian entity, and so there were 2 sets of activities. One set of activity was wherein you did have employees who would come to India, observe whether the quality output is somewhat which is matching the quality standards of the overall Morgan Stanley group, right? And you did have some other kind of other type of employees who had actually come on a deputation. Okay, so in case, for example, wherein they did actually retain a lien on their foreign employment, and they remained on the payroll of the foreign entity, for instance. But nonetheless, they were providing some services in India. Now, what the Supreme Court stated over here is the first set of activities when it comes to activities in which they are only going to monitor the quality. Okay, they essentially regarded as a stewardship activity, would not really result into any kind of a permanent establishment, because that is for your own benefit, right? So this is something which is there for your own benefit of Morgan Stanley US in this case. Okay, it's more of a shareholder activity, let me put it that way. But when it comes to the deputation of employees, this is something which because in this case particularly it was observed that the employees continue to remain on the payroll of MSCO, or they continue to retain a lien on their employment in the US. In that case, this is something which was held to go against them, and that was regarded nonetheless as having a service fee in India. Right, so this is something which is a very common setup, in which you do have a lot of say secondments taking place, a lot of deputations taking place in India. So I'll come to that in a sense, what would be these essential factors one would really need to see, because it becomes very important to really avoid say setting up of a P, because obviously the resultant implications, the costs, the compliances, etc., increase manifold. So this is something which is very important going forward, and I'll just come to that in a short while. Another important ruling is in the case of eFund IT solutions. This is again in the context of India-US tax treaty, very much like what you did have in the case of Morgan Stanley. Now over here, what had taken place is that you did have eFund IT solutions, which had outsourced some of its functions to eFund International Trade India, okay, to provide some back office support services. Now, one of the important discussion points in the ruling of the Supreme Court was where these services were provided. Okay, so if the services were provided within India, now this is where this concept of within India is coming out from the tax treaty itself. So the wording of the India-US tax treaty specifically states that the provision of services have to be done within India. Okay, so within India essentially would mean in India, right? So that's something which is then very important. Now, whether the customers of this eFund IT solutions were located in India, not really, because the back office support services was again the output of which was enjoyed by eFund solutions in the US. So what really happened within India, frankly speaking, was no really great deal. What the Supreme Court observed is that this is something which is not really kind of resulting into a service fee. This is not something wherein your customers are also located within India, and that's the reason, because of the specific treaty provisions, it will not cause a service fee in India. Now, as against which you do have another ruling of the Delhi High Court. Now this is Centrica India. Now, this is something which caused a lot of appeal in the tax world, because this is something which essentially meant that in case of a secondment function as well, that could give rise to a PE. Now, essentially, what is important over here is to observe what the facts were. The facts were that it was one of the preliminary years in which you did have this entity, Centrica offshore entity, which had sent its employees to really set up everything to really kind of help the Indian guys enter into all these kind of arrangements, etc., and actually provide some services here in India. Now, in that context, if you see, in this context, the Delhi High Court had held that, okay, look here, this is something which would, in essence, give rise to a service fee. Now, this is something which is again somewhat controversial, but this is something which went right up to the Supreme Court. But the Supreme Court has only summarily dismissed the SLP. So it was not a speaking order, so that is not the law of the land. But nonetheless, this is something that has taken place. Now, pretty recently, you will have the Karnataka High Court in the case of Flipkart, having considered Centrica, has ruled in favor of the taxpayer that in such cases as well, it would not really give rise to a service fee in India. Now, what we are talking about when it comes to P, what really happens when it comes to a P, as we have been saying, essentially what will happen is, fine, you have a P, and at the end of the day, what will be attributed is the profits which are actually attributable to the P, okay, so which can be connected with the P, would be taxed in India. Now, there are some treaty specifics, like what you see on the screen right now is the India-Switzerland tax treaty. What this treaty says, and this is coming out of the protocol in the India-Switzerland tax treaty, is, and I'll just read it out to you, is it is understood that the remuneration for furnishing of services covered by subparagraph 1 of para 2, so basically your service fee attribution, shall be taxed according to Article 7, which talks of your business profits, your attribution, or on request of the enterprise, so on request of the foreign entity, according to the rates provided for in para 2 of Article 12. Now, what is important over here is the India-Switzerland tax treaty has a service fee clause, which states that provision of any service which exceeds a particular threshold will give rise to a service fee. Also, it has another article, which is Article 12, which also says that, in case there is a provision of fees for technical services, that will be taxed on a gross basis. Now, as I said some time back, generally speaking, a service fee clause has a specific exclusion, okay, to what is covered under your Article 12. But this is something which is missing in your India-Switzerland tax treaty. But again, what is important is you do have this protocol, which gives you a leeway to tax at your request, either on a net basis as per your Article 7, or on a gross basis at 10% when it comes to the rates what are prescribed in your Article 12.2. So somewhat, which is again pretty much unique. This is something which was also held by the Mumbai tribunal. So this is something which went right up to the tribunal. That's what they have upheld this view as well, that this is something which can be considered by the tax authorities, because this is what has been agreed in any case. Now, one of the outlier decisions, if I can say so, as we discussed till till now, rather, you do have in most cases the set idea that, okay, look here, if there is a service fee, you have to actually come here to India, provide services, okay, which should exceed the prescribed threshold. Now, in this particular decision, you would have the Bangalore tribunal dealing with the case of an UAE entity, which did not really come to India and exceeded the threshold. So in the India UAE tax treaty, you do have a threshold of 9 months within any 12-month period. If you exceed that, you form a service fee. The services what we see on the screen are business development, group account management, market development support, etc. Most of these activities were taken place from UAE itself. You just had kind of 3 employees who came to India for a period of 25 days. Now, what the tax authorities held that, okay, that is all fine. We will kind of have this taxed under the India UAE tax treaty. Very interestingly, the ITAT held that, okay, look here, service fee, because there are technological advancements, service fee cannot be foreseen from the perspective that you actually need to come to India. Even though you are providing, what is essential over here is that you have to provide service. Whether you provide service from within India or you provide service from outside India, it will be deemed to be a service fee. Now, this is, with due respect, slightly absurd, because this is something which is going against any set principles which have been laid even by the Supreme Courts. Per se, wherein it is, coming to India is one of the essential criteria, if you really need to have a service fee in India. Now, this is, something which somewhat defeats the purpose. Even, for example, come to think of it, that fine, even if, I am outside India and, nonetheless, there is a service fee, what will be attributed, right? So, because at the end of the day, would that mean that what I'm doing in UAE will then also be attributed to India? Right. So, generally speaking, when it comes to this nexus rule, when you have to have some kind of a nexus to India, if you're coming to India, you're providing this nexus, and then to that extent of that nexus is what you're attributing to India, will never really be there. This is somewhat of an outlier, as I said, but something which is worth highlighting. I don't know whether they really foresee the BEPS even at that point of time, because this is somewhat old ruling, but nonetheless, they kind of went really from that perspective itself. Another important ruling is that in the case of Huawei Technologies, right? So in this case, typically what took place is that you did have a Chinese entity which was supplying telecommunication equipments. Okay, it had a branch office in India, and there were employees coming to India on a secondment, and then there was some kind of commissioning support services, etc., what were provided. Now, why I've highlighted this ruling here is, of course, the tribunal held that it has all kinds of fees, but typically because the concept of secondment is generally done to avoid a service fee. Now, though it is not a case that just, for example, by entering into a simple agreement and bringing the employees over here, and nonetheless, if the employee is doing some work of the foreign entity itself, that you will still avoid a P. That's not what the case is. What you see increasingly in most of these cases, as well as at ground level, is that tax authorities are really observing what is the substance of the transaction. They are taking a lot of efforts when it comes to surveys. They are taking a lot of efforts when it comes to what do you even post on your social medias, right? So even when it comes to your LinkedIn, etc. This is something which the tax authorities are also nowadays increasingly relying on. Now, what took place over here is the Indian entity had a particular contract, okay, for providing some kind of services, but it was not really capable of doing so because it never had that expertise. So there were employees who came to India from China, and they led this entire activity start to end. Okay, and it was observed from a lot of your paperwork, from your appraisal reports, etc., that okay, look here, this is something which the Indian entity could never have done. You did only split this contract artificially, only for the reason that you wanted to avoid the taxation of this in India, of the foreign entity in India. Otherwise, this Indian entity had no capability to do so. So even though there was a secondment, this is again something which is an important aspect, that in that case as well, sufficient care has to be taken that the employees work only for the Indian entity. Okay, it cannot be a case that they nonetheless do work for the foreign entity per se, and in case the Indian entity is absolutely capable of doing so. So providing support is one thing, and actually driving the entire thing is another thing altogether. Now, moving on. So there are a few exclusions, what are provided by the tax treaty in your Article 5.4. Okay. This is an exclusion to the concept of a fixed place permanent establishment. Generally speaking, wherein you do have, or someone is kind of providing any say storage facility, or just kind of maintenance of such goods for say processing by another party, or say maintenance of some maintenance of a place of business only for undertaking some purchasing functions, etc. Only in such cases will this really be an exclusion. Important is what you see in point number 6 to this, which says that in case the activities what are carried out are only in the sense that it is a preparatory or auxiliary character, will this stand excluded. So in the sense that this will be considered as an exclusion to the fixed place PE rule. Now, what is preparatory and what is auxiliary? Preparatory, and this is again something which even the Supreme Court has held in the case what I just come to the next. Preparatory would essentially mean what is carried out in contemplation of the carrying on of essential or significant part of the activity. So for example, you do have a particular activity what you'll be undertaking in India, and you are kind of providing say a market survey for this, which is not really your core activity, okay, which is something which is more of a preparatory work to do so. So something which is not core is something generally which is a preparatory activity. On the other hand, you do have an auxiliary activity which is again carried on to support, okay, but is not still the core activity or the essential or the significant activity. Okay, so if the nature of your activities do fall within these two limbs, it's only in that case that there would be an exclusion, even if you have a fixed place PE in India. Now, few examples I have just listed down over here on what will be considered as a preparatory or auxiliary activity. Like, as I said, a market survey, or development of market opportunities, accounting or financing services, etc. This is generally something which is your preparatory or auxiliary services. Now, the Supreme Court, what I was mentioning is UAE Exchange Center, right? In this case, this is typically a medium in which funds are remitted. Okay, so if, for example, you do have an NRI sitting out of the UAE, he wants to remit something in dirhams to India. Now, how will he do so? He can perhaps go to this UAE Exchange Center, okay, so which is an authorized forex dealer, and he can kind of give them dirhams, which will then be converted and kind of credited in the Indian bank accounts in your INR. For this entire things, basically, UAE Exchange Center had established a liaison office in India. Now, what is the activity of a liaison office? What was done in this case? In this case, the liaison office used to send these instruments or the checks to the beneficiary accounts, okay, of the respective banks. That's all what they did, nothing else. Now, observing this, what the assessing officer, etc., had done is that they had said that, okay, look here, this liaison office is also something, you know, which creates a fixed place permanent establishment and is carrying out one of the essential functions of this entire business. Supreme Court said no. That is not something, you know, which would really be a core function, what is carried on over here. But this is in fact an essential, rather a preparatory or an auxiliary activity. Okay, so what is essential over here is, you know, the transfer of money, the kind of exchange, what is taking place. What is the liaison office doing? It is only acting as a facilitator to kind of go and provide these instruments to the respective beneficiaries. Is it providing any core activity? No. Right, so this is, you know, something which was upheld by the Supreme Court in this case. Another ruling which again deals with that of a project office is that of Samsung Heavy Industries, again a Supreme Court ruling issued in 2020. Now, in this case, this was again a turnkey project in which Samsung Heavy Industries had participated as a consortium member. It had set up a project office in Mumbai for the purposes of acting as a communication channel. Okay. Now, this communication channel was you know, something which had perhaps just a couple of employees who weren't even really qualified enough to, you know, even execute any kind of core business activities. Okay, so they were just there as say a signing authority, just for the purposes of conducting the paperwork of the project office, nothing else. And because again, this is a requirement under FEMA, right, to kind of do so. So and that's the reason, you know, they did had stationed these two people in India. Now, based on these facts again, what is the nature of activity conducted by this project office? Fine, even though, you know, you regard this to have a fixed place because you do have an office, etc., etc., still it will not give rise to a PE, because the activities which are done by this project office is essentially a auxiliary activity, right? So this is, you know, something what was held by the Supreme Court in this case. Now, an interesting ruling is that of the Delhi Tribunal when it comes to GE Energy Parts. So there were 24 such kind of companies of the GE group, okay, which formed a part of this appeal. It also had a liaison office. Now, typically, what a liaison office is permitted to do in India is to represent its parent or group companies in India, is just to act as say a communication channel. Okay, is basically to kind of promote export or import from India, etc. So this is, you know, something which is again defined as a permissible activity from RBI or from a FEMA perspective. Now, there was a survey which was conducted, and it was found that what the employees of GE who were doing, they had the people who had come to India had specific kind of dedicated cabins, dedicated office spaces. They had dedicated email. They were kind of running the show when it comes to your sales and marketing activities. They were running the show when it comes to negotiation activities. They were running the show when it comes to actually kind of representing the foreign entity in India. Now, again, mind you, the tax returns what were filed by all the GE entities were purely on a nil basis, saying that, okay, look here, this is a proper communication channel. But this is what the survey did indicate. And there were interviews carried out with the respective employees of this who are obviously foreigners, and who kind of were very energetic to also post a lot of things on LinkedIn. So this is, you know, something which in fact went against them, because this is, you know, something which the tax authorities did rely on, and said that, okay, look here, this is, you know, something which wouldn't really help your cause. Again, what I've listed over here is what typically the tax authorities are now focusing on. So in this survey, what was focused on was what are the job descriptions and the job responsibilities. They did have a look into the appraisal reports. They did a performance assessment and email correspondence, which the expats had with their head offices and customers in India. What I realized is, look here, these expatriates, even though they are saying that is a communication channel, they were absolutely in full command of the marketing and sales activities in India. Okay, in some cases, they didn't even require the overseas office to even interfere. Decisions were taken here in India by these foreign people who were in India and concluded as well. So again, a few key takeaways for foreign companies operating in India would be to have an absolute detailed intercompany agreement, okay, between your parent and your Indian subsidiary. To the extent feasible, place the expats on the role of the Indian subsidiary, ensuring that they are carrying on the business of the Indian entity itself and not the foreign entity. To have them adhere to the strict social media policies on what really to post and what not to post. What is, again, of course, important is what not to post rather than what to post. To also ensure that the Indian subsidiaries' day-to-day activities are not being managed by the parent company, right? So this is, something which is very important, especially in nowadays scenario, because this is, something which the tax authorities are increasingly looking forward to, and thereby relying on during assessments to strengthen their case, to say that, okay, look here, you do have a PE in India. Now, this is, something what has been there under the tax treaties as of now. You do have some kind of changes what have been proposed under the BEPS project, because what was again observed was that a lot of these foreign companies do fragment their activities, in the sense that, they say if there could be a core activity, what they do is that they kind of essentially split this into, for example, 10 different activities, which are then portrayed as a preparatory and auxiliary activity, when essentially, if you look at them all together, they are essentially your core activity by itself, right? So this is, something which was again proposed by the MLI, by BEPS. And this is, something what you already do see forming part of some tax treaties, including the India-UK tax treaty, which has this option A, what is displayed on your screen. So this is, something which is now expanding the scope of your, or rather restricting the scope of your Article 5.4, and saying that, okay, look here, this is, something which will also now give rise to a P. So you have to see it in as a cumulative approach. Another aspect over here is that of a dependent agent PE. A dependent agent, say, of course, a dependent agent is someone who is actually dependent on the foreign entity or on whom they actually do represent. Okay, dependent in what form? They can be economically dependent or legally dependent. In the sense, for example, if most of the income is kind of comes only from one source, or say, for example, they are legally bound by this kind of foreign entity, is when you would really form that, say that, okay, this entity is a dependent agent PE. Now, pretty recent ruling, what is now displayed on the screen, is that of Reddington Distribution. Now, Reddington is an Indian company, which is one of the companies, for example, which is kind of a distributor of, say, iPhones in India. Now, what happens in this case is that Reddington is India, so it has a subsidiary in Singapore, and Singapore is the one who kind of does all these sourcing activities for the iPhones. But what is important over here is that even though the activities, or rather the contracts, are concluded by the Singapore company and whichever say entity in India, who concludes these contracts, who really sources or actively solicits these contracts on behalf of the Singapore entity, what was observed by the tax authorities. So what was observed was that there's a team which is known as a dollar team, right, in Reddington, India, which kind of conducted all these activities for the Singapore company in India. And basically, essentially, resulting into the fact that they were more or less acting as an agent for the Singapore company in India. And that's what the Chennai Tribunal also held, that a dollar team of Redington India constitutes a dependent agency, PE, in India for a Singapore subsidiary. Now, again, what is important over here is, if at all, there could be any attribution over and above your existing kind of attribution, what is done, or the existing commission, what is being paid to your agent. If at all there is something with, if at all they say that is not at arm's length, then there could be some additional attribution which could be made in the hands of the Singapore subsidiary in this case. And this is a decision which just came perhaps this or the last week, which is that of Google India. Now, Google India, now this is typically in case of a distributor. And this is particularly significant because, as most of you would be knowing, that you did have a Supreme Court ruling in the case of software transactions, in the case of engineering analysis, in which case the Supreme Court held that, okay, look here, when it comes to your off-the-shelf software, etc., this is something which will not really kind of be regarded as a royalty payment, subject to there being no PE. Now, what we see on ground is that a lot of inquiries being made in such cases to see that there is a PE in such case, and they're effectively attributing that income over here. Now, when it comes to Google India was acting as a distributor for their AdWords program. And was not really, so it was doing in its independent capacity. Okay, so that was not really something which was done on behalf of Google India, but nonetheless this was an allegation which was made by the assessing officer, and having a look into the clauses of the agreement, having a look into who was responsible for the payments, who was responsible for this distribution, etc. The tribunal came to the conclusion that Google India is not the dependent agent PE of Google Ireland in this case. Now, Article 5.7 is something which is that of a PE, in the sense in which case, I mean, whether all types of an agents are by default PEs, right? So that's obviously something which is not the case. You do have something which is known as an independent agent. Okay, so in the sense, an agent which is not dependent wholly or legally, or rather not wholly legally, legally or economically, is more or less an independent agent. Okay, so in this case, if that agent is an independent agent, there is a specific exclusion in your tax treaty itself, saying that in such cases, this is something which will not give rise to a PE. As we have seen in our earlier discussions, you do have, again, some kind of wordings in the multilateral instruments, which expands the scope of your permanent establishment relating to a dependent agent, a PE. So before, in most of the treaties, it was only that the DAP or your dependent agent PE was held in case there is an actual conclusion of contracts. Now, what is proposed, and in some cases, what has also formed a part of some Indian tax treaties, is that in case you do conclude a contract or habitually place the principal role leading to the conclusion of contracts with no material modification by the principal, even in this case, will you be regarded as a dependent agent PE. So even though you are not actually concluding a contract, but you are actually playing a principal role, which results into conclusion of the contracts, and there is no material modification into whatever role you have played, then as such as well, this is something which will give rise to a dependent agent PE. Now, this is what I have highlighted over here in bold. This is something which is also formed a part of the Act. What I read in the start, that the Act now, the domestic tax law, also now includes these wordings of principal role leading to conclusion of the contracts. Again, before you did have a specific, you did have a specific wording saying that depending on the facts and circumstances, an agent acting on behalf of the related enterprise could be considered to be an independent agent. In these, in this specific kind of case, you do have. Sorry, the charger on. Yes, a case in which a person acting exclusively or almost exclusively, okay, on behalf of one or more enterprises to which it is closely related shall not be considered to be an independent agent. As we saw, an independent agent is a specific exception to the dependent agency rule. So this is something what has come out specifically now, that in case you are doing so exclusively or almost exclusively when it comes to a closely related enterprise, then you will not be considered to be an independent agent. And closely related is also something what is defined, which is your 50% or more beneficial interest. Now, okay, one of the last rulings what I would take is from the Bombay High Court. And this is where you did have a Mauritian company which was engaged in the business of telecasting of TV channels. And you did have a person, who was acting as an advertisement collecting agent for this Mauritian company. Basically, he did market time slots, etc. Now, the tax authorities held that, okay, look here, he's the one who is the dependent agent of this Mauritian entity, and accordingly, there was some profit attribution which was made. Now, observations of the tribunal which was upheld by the Bombay High Court were that this agreement, they never demonstrated that B is the one who's a decision maker. He was more of a communication channel. Okay, he used to say that, okay, look here, these are the time slots. If say there is any kind of a reward what he used to get, he used to just pass it on to the Mauritian company. Was he a decision maker? No. Did he have authority to conclude contracts? No. Did he have authority to fix the rates? No. So essentially, he didn't really represent the client more so as an agent, but was merely more so like typically what a liaison office would essentially function. And as we saw before, in case a liaison office actually restricts itself to being a communication channel, in that case, ideally, it should not really result into a PE. This is more or less what was again held in this case as well. Now, as we have been discussing, when it comes to the happenings till date, you do have the concept of a permanent establishment, which is typically on a brick and mortar model, right? So in the sense wherein you do have a case wherein you actually do need an office, and in case of a fixed PSP, or you actually do need an agent, etc., etc. Now, what happens in this highly digitalized world? Do you even require such kind of brick and mortar business entities to even survive? You don't really require that, right? So in the sense, for example, a company setting out of the US by a mere click of your button can do business in India. Similarly, an Indian company, for example, can do business in Australia. You don't really require yourself to be there physically. Now, addressing this, there were some kind of initiatives what were also taken to expand the scope of this permanent establishment, to say that, okay, there could be taxation of these new age businesses or of these digital era businesses, and which is very broadly or loosely known as a digital permanent establishment. So in India, for example, there are at least two measures which are taken to kind of tax these kind of activities. One is, as most of you would be aware, is that of an equalization levy, right? So which has been enacted in the Finance Act in 2016 as well as in 2020. You do have an expansion of the definition of significant economic presence. So basically, this is again something which is there in the Act, what we saw some time before, in which the traditional way of doing business has now been expanded. Now it is just based on a particular threshold of number of users interaction, or on if you're going to cross a particular kind of limit when it comes to transaction of goods or services, right? So this is something which is coming up pretty much fast. There are a lot of other discussions what are currently ongoing in the BEPS sphere when it comes to Pillar 1 as well as Pillar 2 approaches, but these are more so attribution rules to these kind of different Ps. What India has also entered into as an agreement with at the G20 level is that once the Pillar 2 as well as Pillar 1 is actually enacted, it will do away with your equalization levy and other unilateral measures, right? So this is something which is a commitment what has been made by India. at this global forum. So let's see. I mean, this is something which is definitely bound to take up some time as well, because this is something which is not restricted to India. This is something which is there at a global level, and obviously you need to have a consensus. Though there are some countries who have already, say for example, at an EU level, who have already gone ahead to kind of adopt all these things as well, right? So that's so I mean, we are kind of entering a pretty exciting time at this point of time when it comes to permanent establishment, as well as especially rather for the new age businesses. So just as a parting note, as I said, permanent establishment, it's kind of litigations, etc., are definitely bound to increase. This is something which would be very much essential to have proper and appropriate documentations to be there in place. You need to actually substantiate now, because substance is something which is extremely essential, rather than just having rather than just having or relying on the form of the transaction, right? So that's something what I wanted to cover. Thank you for your time. I'm not aware if there are just time for questions. If that be the case, happy to take it up.
So there are a couple of questions in the chat box,
Mm-hmm.
Q&A box, sorry. So probably I'll read out,
Yep.
so it will be easier. If a resident director arranges a contracts or plays a vital role in identifying or generating the business in India, then will he be considered as non-resident?
So if a resident director arranges contracts and plays a vital role in identifying business, if I understand you correctly, that will be business for the non-resident. So I mean, obviously he will not be considered as a non-resident in India, because he's a resident director. He remains as a resident. So that is out of question for him to be considered as a non-resident. What could take place, again, depending on the facts, is that if he's acting or playing a principal role in conclusion of these contracts, this activity could be regarded as having a dependent agency exposure for the foreign company in India. Right. So, I mean, he obviously will not be a non-resident, but there would be an exposure for the foreign company in India.
Right. One more case is in case of SEP, advertisement targeted customer and equalization levy provision, what will be the difference?
So, okay. So the thing is, when it comes to SAP, okay. So the thing is, typically there are, see, equalization levy is again, something which is advertisement based. There are certain transactions which are covered under your 2016 provisions. There are certain transactions covered under 2020 provisions, which go a step above, rather beyond this, right? So the thing is, in some cases, yes, there could be an overlap, but there are some thresholds, what are prescribed under your SAP. SAP is generally, what will be taxed on a net basis, if at all, say there is something which falls under the ambit of SAP. Equalization levy as well, yes, there is a threshold what is prescribed, but again, that will be on a gross basis straight at 2% or 2%, or in case if it's at on a 2016 basis, that will be more or less a TDS at 10%.
Right. Then do we have to check the residential status test based on the number of days for a PE? For example, how in case of a Formula 1 case study as explained?
No, so in case of, see, a PE per se, if at all there is a permanent establishment of the non-resident, by default it's a non-resident. Okay, so I mean then it's not a case that it becomes a resident. Okay, the thing is, generally when it comes to a fixed place PE, there is no threshold prescribed. As I said, this really depends on what your nature of business is. If your nature of business is such which really is only for a short-term period, then of course you need to see the level of permanence only from that context. So the Formula 1 ruling does apply. But if that is not the case, if that's not what your nature of business is, as I said, generally not really as a thumb rule, but generally period of 6 months is what is taken as a kind of a fair estimate.
Right. One query, I think I should break that query because there are a couple of things. First, in case of my client is earning around 50 crores in US. I have a place of business in India. the cost of the said premises, say salary, rent is 20 CR. And by applying the safe harbor rule, I have added a margin of 18.5%, so that in case of a balance value of 30 CR, it's still chargeable to tax in India, even if the amount has not been brought into Indian entity by mode of a change in rules of BAPS. So it is a primarily pharma business marketing and pricing mechanism service, that is the consultancy services. So there are different questions. So I feel the question is a little unclear as to what exactly is required. So you can just...
Yes, I'm not sure. I mean, if the participant can please mention what the question is.
If there is any clarification, if has been received. No, I don't
see.
think...
In the sense, this appears to be, I mean, very prima facie straight out a cost plus scenario, right? So in the sense, you do have a, if I understand it correctly, a 20 crores cost base in India. You're opting for a margin of 18.5% on a safe harbor basis, which in any case is getting taxed in India. Absolutely fine. But yes, I mean, if the question is whether there can be any further attributions, etc., I mean, I'd be happy to answer. I'm not really aware of what exactly is the question here.
Right. So another question. Suppose a group manager of a foreign company visits India to assist the Indian subsidiary for more than requisite time limit as per the relevant DTA to trigger PE. In such case, the objective or the purpose of his visit is to benefit the business of Indian subsidiary. How can the PE risk be mitigated in this situation?
So again, what is important to know is what is he really doing in India, and see, I take it at face value that it is for the benefit of the Indian subsidiary and not really a stewardship activity. See, because if it's a stewardship activity, of course, as we saw in Morgan Stanley, there will not be a PE. But when it comes to him visiting India, providing some services to the Indian entity, etc., assuming that he's falling under the service PE rule. So as I said, typically, generally speaking, you do have a typical secondment arrangement, right, which is entered into to mitigate the PE risk. But again, you need to take sufficient care. You need to have sufficient documentation to say that what you're doing is only rather during this period of secondment, you're acting only for the Indian entity, as well as working under the directions of the Indian entity and working for the benefit of the Indian entity. If that be the case, this is something which could be a solution.
True. Then in case of an Indian captive marketing and sales support service provider, if the employee performs negotiation functions, whether there is a risk, there is a PE risk for the foreign company, and if yes, whether the arm's length remuneration on cost plus basis to the service provider would mitigate the profit attribution risk arising from the PE risk.
Yes, well, it's pretty specific, but okay, let me nonetheless attempt. See, the thing is, okay, say typically, if you are providing some kind of captive market sales support activities, now fine, yes, whether there could be a PE risk, yes, again, depending on your activities, assuming that yes, you also do have a PE risk, okay, and especially with this kind of enlarged version now, assuming that that's what the tax treaty says of a principal role, etc. Assuming you do have a PE risk, there are a lot of rulings in your favor to say that in case the commission what is being paid to this the Indian entity is at arm's length, ideally there should be no further profit attribution, right? So that's something which is there. Of course, there could be other implications under GST of intermediary, etc., but I'm not addressing that at this point of time.
Correct. If the books of accounts are maintained in India or on Indian server, whether it would be termed as service PE and treated as FPOP. So books of accounts are in India, or probably the server is in India.
Okay, just need some more clarity over here. See, only if books of accounts are maintained in India, that's perhaps fine. In the sense, there could be an arrangement wherein there could be, say, some kind of an outsourcing function it's fine. I mean, I wouldn't really see that to be a big risk. But when it comes to Indian server, so in the sense, if there is a server, what is here in India, that's something which could definitely give rise to some issues. I just if there is some more clarity on this, I will just be pretty happy to answer.
So the clarity what they have provided is like, would the answer change if invoicing services are provided, including GST registration obtained under the GST law? Can you please enlighten? So probably the invoicing is also happening through India, in India only, by charging GST also.
Okay, so this appears to be more so of an accounting outsourcing, or your kind of a typical back office support function, right? So for example, you do have a lot of entities, even in Pune, who do kind of your US accounts, etc. In which case, you do kind of have your kind of books of accounts, which are kind of prepared, maintained in India, etc. In such cases, I mean, typically you are the one who is actually providing some services to them. Okay, so ideally it should not really give rise to a service fee or a fixed place fee in that case. Again, important is who has control over the server. Okay, so if the server is again under the control of the foreign entity, if they are the one who is kind of having this at their disposal, this is something which could be a slight risk. Typically, I wouldn't really assume so.
Right. And regarding the earlier question about 20 CR and 30 CR, the clarification has come like, we need to understand, will there be any further attribution of rupees 30 crores? And what can be the basis for the same, as we are not bringing the amount to India, but the service is being provided from India?
So I'm not sure when we mean the amount is not being brought to India, because for example, if we are the one who's providing services, we are the ones who's invoicing, I would tend to believe the amount should actually come to India. I'm not able to understand why does the amount not come to India in this case? Because if it's a cost plus arrangement, I'll be invoicing this, for example, to the US entity. They will be paying me. So is this something, for example, wherein the amount is held for some reason, say beyond a period of 120 days or something of that sort, or what exactly is the issue? Right. I'm not aware. Typically, when it comes to a PE structure, it wouldn't really kind of have any implications for a PE just because the amount is not really brought in. Okay, what is important is what is the functions, what you are carrying out. If that is something which gives rise to a PE, then obviously all these facts are extremely important. As much as I've understood, and happy to have any more clarifications, that if you are only providing any kind of outsourcing functions or other cost plus functions over here, this is typically something which shouldn't really give rise to a PE.
Sure. And the last question which I can see is, if a company, say LinkedIn US, is having PE in India, but if the contract is with the LinkedIn US, the service being marketing and finding clients in US for Indian company. So both the contract and service is provided outside India. In such a case, will still the service be taxable in India under 195 or any other section? And likewise, if I open an entity in Singapore and make the payment to consultant who is based out of Singapore for providing the services in Singapore, do we have any taxability issues in respect of 195? So there are two questions.
Okay, let me take the first one. If a company, say LinkedIn US, is having a PE in India, so it's an admitted fact that it has a PE, but if the contract is with LinkedIn US, service being marketing and finding clients in US
for Indian
company. So the contract, I believe, is between two US entities, right? LinkedIn US and whichever other party. Correct. For the purposes of finding clients for US. So both the contract and service providers outside India. In such a case, is the service still taxable in India under 195 or any other section? Ideally, no, in the sense, ideally, because there is the P is not involved anywhere over here. Okay, so the thing is, I mean, what is generally taking place is an NR to NR transaction. Okay, so my prima facie opinion would be that ideally there shouldn't really be anything which is attributable to your P, unless of course the P also kind of plays any role to this. Then I mean, obviously that's something which will come under the ambit of your 195. Now, likewise, if I open an entity in Singapore and make payment to a consultant who is based out of Singapore for providing service in Singapore, and they do not have any P in India, then how is the taxability? No, this is something which is different to my mind, because over here you do have an entity in Singapore and you are obtaining some services from the Singapore resident. Okay, so well, now again, having a look into, so this generally appears to be more so not really a PE issue, but more of a 195 for your payment towards fees for technical services. So under the Act, I mean, of course, this is something which should be taxed. The India-Singapore Treaty has a make available clause. Ideally, I mean, if it is something which is not making available, ideally shouldn't really have an implication on the 195.
Right. And one question which I can see in chat box is, in case Indian resident working from home as employee of Singapore company, can salary paid to such employee be foreign salary, or because of any connection that amounts to PE, whether the tax rate will be available?
Let me just go through it.
So Indian resident is working from home as employee of Singapore company.
Okay, Indian resident
Working from home as employee of Singapore company. So probably he's working from India.
He's working from India, okay, as
Or
employee
Singapore company.
Singapore company, and
Then
salary
paid to such employee, can it be considered as a foreign salary, whether it can be considered as a PE of the foreign company, and if so, whether the tax rate will be available?
Okay, so see, I mean, again, it depends on what he's doing, frankly speaking. Okay, so if he's going to really go and enter into some contracts, etc., obviously it will have its own implications. Say, assuming that he's say, for example, in an IT setup, okay, and he's kind of just doing some software development activities over here. Now the thing is, there is no kind of great judicial precedent when it comes to a home office P in India, in the Indian context rather, but nonetheless you do have a couple of judgments which give some hints to this, in the sense, if the place where you're working, if that is being maintained, okay, by the foreign entity, in the sense, when I say maintained, that is typically, for example, when the foreign entity is paying for your rent, paying for your laptop, your water, internet, and all these things, etc. So in such cases, there could be a presumption that this is something which is at the disposal of the foreign entity and which could give rise to a PE. But as I said, this is at this point of time at least not a great focus area for the revenue authorities. But certainly, I mean, we the contracts, or what the foreign entities are doing, they need to be a little bit cautious for this, right? So this is something what it is. Regarding his taxability in India for the salary, this is something which will depend on what his residential status is, because that will not really. I mean, if he's working from home itself, presuming he kind of becomes a tax resident in India, then even be it a foreign salary or an Indian salary, it will be taxed in India, right? So that's something what it is. Yes, I mean, if there is any tax withholding done in Singapore, he's generally be able to get a credit in India.
Right. So I think we have answered all the questions both in Q&A box as well as in chat box. I'll just go through once,
Sure,
so that we not miss. Okay. So I think we have answered all the questions. So thank you so much, sir, for such a wonderful session. And deliberating on various Supreme Court case laws as well. So like UAE exchange is there, Morgan Stanley is there, various tribunal case laws are also there. So this has actually given us new food for thought, that so many different parameters or the complex situations may arise, which we need to have a better clarity, probably going by the case laws or maybe the other judicial pronouncements. So excellent session, what I can see as a response from various participants, and we are very much thankful to you for giving such a wonderful session, and looking forward for many of those.
Thank you. Thanks a lot, Pranav, and the Pune branch. Absolute pleasure. Thanks for the opportunity. Thank you.
Sir, so someone raised hand and they have one query. So can I allow?
Sure.
Yes.
Ujjwal sir, you can talk now.
Hi, sir. Can you hear me?
Yes.
Okay, so that means I've posted multiple questions. That is around that 50 crores is there in the US. Basically, what I
Yes.
wanted to ask is the parent company is there in the US and the Indian subsidiary is there in India. But basically, the entire service is being provided by the Indian subsidiary only. And the parent company is still retaining a few funds out of there just because under cost plus model basis, they are needed to transfer only 20 crores plus whatever is the 18.5% margin, which is there. So in that case, the balance 30 crores, which we are maintaining as profit with the US entity or with the parent company which is there, will there be any profit sharing? Because we have a permanent establishment in India, but we are not bringing in the funds in India. Just from the sake of making that point of bifurcation that it is contractual fees are basically for getting the clients, it is the fees which is retained by the parent company.
Okay. Can you please explain me what is the nature of service what the Indian subsidiary is providing?
Yeah, so it is basically software as a service kind of a thing, or you can say it is artificial intelligence of providing pharma research and marketing.
Okay. So is it a case that, for example, you do have a parent company in the US, right? Because this is a very typical structure that you do have in most of these software companies, a parent company in the US, for a simple reason that most of the US companies do prefer to have or interact only with US companies, right? So that's what it is. Typically, you do have a sales and marketing team over there, and you do have say all your outsourced functions in India. Is firstly that the case, or is it a case that you do have say a US kind of a parent who actually is also providing some kind of your development of your IPs, your management of your IPs, and as well as exploiting of your IPs in the US, has an actual team who is working on this as well as the sales and marketing function, and only the outsourcing function is taken care of in India. So what is the fact scenario over here?
The second case, sir. They have a team in the US.
Okay.
They have almost about say the 200 people working over there, and there are another 200 people working in India parallelly for different projects altogether. Or there could be some mutual projects as well, for which they are working, wherein the US team and the India team are both submerged. Few of their employees, few of our employees. But still, that means that the retention percentage is not defined, and it is just under a cost plus model they are transferring for covering up the cost in India plus an 18.5% margin to be maintained. That's it.
See, I mean, based on what I understand, typically in this case, the Indian entity is providing your routine kind of software development functions, your IP as well as say, I mean, typically under transfer pricing, I'm sure this will be covered under the next sessions. There's something which is known as a DEMPE rule. Okay, your development, exploitation, maintenance, protection of as well as enhancement of the IPs. The IP, to my mind, lies with the US company. They have the entire right to exploit this IP. All what the Indian company is doing is only kind of developing the software based on the instructions of the US company. The US company has a sales and marketing team which is going to get all these contracts and is going to give a specific task to the Indian company, on basis of which there will be a development function. If that is something what it is, generally speaking, this is something which is a routine function. If you're under safe harbor, in any case at 18.5%, that the cost plus 18.5% is generally what is sufficient. Generally, only on these facts there should not be a PE or a further need for an attribution. But as I said, this is something what is a basis on what I've understood from you.
Sir, just one point of clarification in this. What you're saying about the IP is right. It is the IP lies with the parent company in the US. But the only point of difference is the sales and marketing is being taken care by both, and there is business consultation which happens. So more than software as a service, what we are selling is business consultation, so that they can. So for example, if I say if I want to sell Crocine in United States, so on which street, which that means in which territory do I sell it, so that I get the maximum benefit out of that. So that is what is as a service that I'm providing. It is basically business consultation to the pharma companies.
Great, but then what is the Indian company playing as a role in this?
The entire consultation, so that means they basically get the entire that means although the IP lies with the US company, the entire fragmentation, the entire data analysis, the entire artificial intelligence to get that data, for bifurcating the right data and giving them a picture perfect analysis kind of a thing, and likewise even giving them further consultations on where they can actually sell and how they can do the entire marketing campaigns and everything to prioritize on that project or to maximize the gains on that product altogether. So that is what the Indian company is doing.
Understood. See, I mean, again, based on these set of facts, see, I'm sure, firstly, all these things would already be forming a part of your transfer pricing documentation, right? So the thing is, I mean, at the end of the day, if you are nonetheless falling under your arm's length criterion, should still be fine. But again, typically, in the first set of facts, when it comes to your software development services, as I said, I won't really foresee a big issue over there. But the thing is, because you're doing your marketing and servicing function for your group entities, which is resulting into some kind of a project or some kind of a contract. This is where perhaps you just need to be a little careful about and perhaps evaluate what is the role which is played by the Indian entity, and say, for example, if there needs to be a further attribution over and above your 18.5%. So this is something which I believe should definitely be done.
So that is basically on the sales and marketing front, right? For
Correct.
selling that product.
Correct.
Oh, okay. Understood. Absolutely. Thank you very much.
Thank you.
Thank you, Rajesh sir.
Thank you so much, sir.
Perfect. Thank you.
Yes,
My
thank
pleasure.
you.
Thank you.
Yes, we'll end up the
Thank you.
session for today, and
Thank
we'll meet
you.
tomorrow. Yes, thank you.